One of the most important financial decisions you will ever make is how you invest at different stages of life. And if you're not doing it right for your age, you could be losing out on thousands of pounds. A common approach is to use the rule 120 minus your age to determine your stocks allocation. According to this rule, you simply subtract your age from 120, and the result is the percentage of your portfolio that should be invested in stocks, with the rest allocated to bonds. Another popular option is target retirement funds, which automatically adjust their allocation over time, gradually increasing exposure to bonds as they approach their target retirement date. Similar to the 120 minus your age rule, target retirement funds reduce stock exposure as you age. For example, according to Vanguard, if you're 30 and aim to retire at 65, the suggested allocation based on this target retirement fund is 80% stocks and 20% bonds, slightly more conservative than the 120 minus your age rule. At 40, Vanguard still recommends an 80-20 split between stocks and bonds. At 50, the ideal portfolio shifts to 71% stocks and 29% bonds, and by 60, Vanguard suggests the classic 60-40 portfolio, with 60% in stocks and 40% in bonds. So according to Vanguard, these are the optimal allocations at different life stages. However, you'll notice that none of these approaches recommend having 100% of your portfolio in stocks when you're younger. Even for someone with 35 or 40 years until retirement, these funds don't go all in on stocks. So why is that? Do these fund managers know something we don't? Are we making a big mistake by investing 100% of our portfolio in stocks? Or should we take a more diversified approach across different asset classes? Well, the first reason comes down to risk management. The argument is that yes, stocks grow faster than bonds over time, but they're also extremely volatile. Even if you're investing for the long run, there will be periods where the market takes a nosedive, sometimes by 30%, 40%, or even 50%. If your portfolio is 100% stocks, you're feeling the full force of that drop. But if you have a small allocation to bonds, even just 10 or 20%, your overall losses won't be as severe. That might not seem like a big deal when looking at the chart, but in real life, when you see your portfolio drop by half, it can be mentally brutal. This ties into the next point, the investor behavior factor. A lot of people think they can handle stock market volatility until it actually happens. It's one thing to say, I'll stay the course no matter what. But it's another thing entirely when your portfolio is down 50% and the headlines are full of doom and gloom. The truth is that many people can't control their emotions and they panic and sell at the worst possible time, despite the fact that they have a long-term investment period ahead of them. This is why, according to these asset allocation approaches, even a small allocation to bonds can be helpful. It smooths out some of the ups and downs, making it easier to stay invested through market turbulence. And finally, there is the data. Historically, a 100% stock portfolio does provide the highest returns. There is no question about it. But the difference between 100% stocks and say a 90-10 or even an 80-20 portfolio isn't actually that big over long periods. Meanwhile, the 80-20 or 90-10 portfolio experiences significantly smaller drawdowns. In other words, you're getting almost all the upside of stocks, but with less of the extreme downside. That's why these asset allocation strategies suggest holding some bonds even if you're young and just getting started. It's a way to get high returns with lower risk, rather than chasing every last percentage point of return at the cost of higher volatility. This brings us to the big question. If we have 30 plus years ahead of us, should we follow this more balanced approach, or is it fine to stick with a 100% stocks portfolio? The answer depends on how much volatility you can personally handle. If you're completely fine seeing your portfolio drop by 50% or more and you're confident you won't panic sell, then a 100% stock portfolio is mathematically the best way to maximize returns over a long horizon. But if a sharp drop in your portfolio would make you second guess your strategy, then having some bonds, even just 10 to 20%, could be a smart move. It won't drag down your returns much, and it might make it easier to stay invested when things get rough. At the end of the day, the best portfolio isn't the one that looks perfect on a spreadsheet. It's the one that you can stick with for the long haul. Now, interestingly, some recent studies challenge the traditional idea that we should shift more into bonds as we approach retirement. Instead of gradually reducing exposure to shares over time, These studies argue that maintaining a high allocation, even 100% in shares, can lead to a larger retirement pot and reduce the risk of running out of money. For example, this paper suggests that staying heavily invested in shares, even in retirement, can actually improve long-term financial outcomes. This isn't a very surprising discovery. In the end, shares have historically outpaced inflation and provided higher long-term returns than bonds. Bonds, while more stable, don't grow as fast. It's a fact. So if you shift too much of your portfolio into bonds, especially early in retirement, you risk your investments not keeping up with inflation, which could erode your spending power over a multi-decade retirement. Of course, this strategy isn't for everyone. There are some important risks to consider before deciding to go all in on shares, whether you're young or retired. First of all, while shares provide the highest long-term returns, they also come with significant short-term volatility, as we discussed earlier. If a major crash happens early in retirement, it can permanently reduce a portfolio's longevity. This is why some retirees prefer keeping a portion of their wealth in cash or bonds to cover their short-term spending needs. Secondly, as we discussed earlier, not everyone has the same emotional tolerance for risk. A 100% shares portfolio looks great in historical charts, but actually living through a 50% drop is a different story. If you panic and sell during a crash, you can lock in massive losses. So, a strategy that maximizes returns on paper is useless if you can't stick with it in real life. Finally, personal financial situations matter. A retiree with other sources of income, such as a generous workplace pension or rental income, may have more flexibility to stay invested in shares because they don't rely entirely on their portfolio. But someone with no guaranteed income and high expenses may need a more balanced approach to ensure they can weather market fluctuations. So where does this leave us? Well, while some studies argue for maintaining a high equity allocation even in retirement, in my opinion, it still makes sense to gradually reduce exposure to shares as you approach the point where you'll start withdrawing from your portfolio. Because once you start withdrawing, your investment strategy shifts from purely growing your wealth to making sure it lasts. The biggest risk at this stage isn't just volatility, it's the risk of withdrawing money after a market crash and permanently depleting your portfolio. When you're young, market downturns are just opportunities to buy more at lower prices. But once you start selling investments to fund your lifestyle, a major market crash can have a compounding negative effect. If you're forced to sell shares at low prices, you lock in those losses, and your portfolio may never recover. For that reason, I believe it makes sense to gradually lower your allocation to shares as you get closer to withdrawing money. Not drastically and not too soon, but enough to reduce the risk of having to sell shares during a downturn. Here is how I think that might look in practice. And please keep in mind, this isn't financial advice, it's just my opinion. In your 20s and 30s, your main focus should be growth. You have 30 to 40 years ahead of you before retirement, which means you have plenty of time to recover from market downturns. A high allocation to shares makes sense because you can ride out volatility and benefit from long-term compounding. In your 40s, you're still prioritizing growth. And given that you are still 20 plus years away from retirement, I believe it makes sense to continue with 100% stocks. However, if you plan on retiring earlier, or you think you won't be able to control your emotions during a market downturn, it might make sense to introduce a small buffer of stability. The 10% in bonds isn't there to generate returns. It's there to provide a cushion in case you ever need to rebalance during a downturn. This, of course, depends on everyone's personal situation. In your 50s, you're getting closer to retirement. And while growth is still important, capital preservation starts to matter more. A higher bond allocation helps reduce the impact of short-term market fluctuations. That's why I believe holding 70 to 75% stocks and the rest in bonds is ideal. Again, this all depends on when you want to start withdrawing money. Because if you aim on using it in the next 5 years, it may make sense to have an even higher bond allocation. In your 60s, you're either approaching withdrawals or already making them. So the goal is to balance long-term growth with stability. Too much in bonds and you risk running out of money due to low returns. But too much in shares and you risk a big market drop right when you need the money. A roughly even split helps manage both risks. So 60-40 or 50-50 is probably best at this age. This kind of gradual shift allows you to capture long-term stock market returns while also reducing volatility risk as you near retirement. It doesn't mean abandoning shares entirely. Far from it. Even in retirement, you still need growth to combat inflation and sustain your wealth over multiple decades. But the key is reducing the risk of being forced to sell shares at the wrong time. Ultimately, the best asset allocation is one that balances growth, stability, and your personal risk tolerance, so that when the markets inevitably go through turbulence, you can stick to the plan and not panic when your ETFs start crashing.